Hi, I'm Stacey Hyde and I'm back with another episode of Better Financial Health in 15 minutes or less. And today I want to talk about what's going on in the markets. Inflation is setting records that we haven't seen since the 80s. That's not a good thing. And the stock market has reacted negatively to that because as interest rates go up, it makes those earnings in the future worth less today. And what I mean by that is interest rates go up, also known as the discount rate. When you bring those earnings back to future days, it means that they're less valuable. And so it causes, particularly like technology stocks and the higher growth companies, it really has a big negative impact on them. But no market sector was immune from the pullback yesterday. And as I'm recording this, it is Tuesday, June 14th, so I'm talking about Monday, June 13th, which disappointingly followed a day on Thursday and Friday of last week where the market also went down. So everybody's a bit on pins and needles. It's this is a terrible, no good, bad day, and in the south we're having huge heat waves, so we've had a lot of combination of things that just didn't feel good. High heat, which makes everybody on edge, interest rates going up, and also markets going down. Well, what should you do about that? Well, first thing, try to stay cool, stay in air conditioning. If you need to get outside, do it early or late. But interest rates, if you have credit card debt or floating rate debt, to the extent you can, pay down on that, because your interest is going to get larger than it has been in the past. It's always a good idea to pay off credit cards and not carry a balance month to month. But if you're looking at larger purchases, it makes those 6 months no interest even more valuable than they had been here recently. But it also can have a negative impact if you're looking to buy a home, because 30-year mortgage rates are now getting close to 6%, and that means that you're likely to pay twice the amount of interest on a mortgage loan than you would have had you purchased last fall. And that can be a hard pill to swallow. Now, historically, 6% mortgage rates are not all that high, but what people have become accustomed to, especially with the rise in housing prices, that's a lot harder to cope with. So it may mean that you need to save more money, look at a slightly lower house price, and it may take some of the frothiness out of the market. To do with your stocks, since with respect to your portfolio, what should you do there? Well, my hope is that you have a well thought out portfolio that matches both your time horizon and how much of a roller coaster or risk tolerance you have. And so if that's the case, really just keep buying, because right now you are buying at a 20% or sometimes in technology cases, 30% off sale. And those companies are still the same companies today as they were yesterday. It's just what the market is willing to pay for them has gone down. And we often see this when markets have a big sort of visceral reaction. Everyone tries to jump out, or they just dump stocks because they're going on vacation and they don't want to worry about it. And the bonds were supposed to be safe, and interest rates have gone up, so they've gone down in value too. And everything's bad. I'm selling everything because I can't afford to keep losing. Well, while that may give you some sense of security and let you feel like you're doing something, what you've really done is cut yourself off at the knees, because when you sell at moments like this, when markets are way down and you go to cash, all you're going to get is that cash return. You've already suffered the losses of 10%, 20%, whatever it is. And in order to get back to where you were before, you need 10, 20, 30% returns to the good side. and you're not going to get that in cash. And people will often tell me, I'm getting out now and I'll get back in when it gets better. But I go back and I'll tell you, history shows that after we suffer a big drawdown of 10% or 20%, then the future 1-year returns are as high or higher a majority of the time, a good majority of the time, than they were on a year where we just were up slightly or even up big. Because when you come off of a down year, it gives companies the ability to grow their share price again, especially if their earnings are hit by sort of one-time shocks. You know, their cost of goods has jumped up and they weren't able to pass all that cost onto their consumer because the consumer is stretched too, but they've held on to their customer base because they've kept prices reasonable. So yes, their earnings went down, but they're still a good company, they're still in business, they're still making money, their just profit margins have gone down, which if you think about it, that's sort of what you're seeing in the average family. They're tightening their belts, they're maybe buying less meat, more vegetables, substituting, maybe changing where they go to the grocery to save money. And companies kind of do the same thing, and that's a good thing. So I've used a whole lot of words to say something that in basic form is keep buying. Don't stop contributing to your 401k. Don't stop adding to your investment accounts on a monthly basis. Pay down on your debt, tighten up where you can, and maybe plan a little bit further. You really want to make sure that you're taking advantage of savings where you can and still doing the things that give you joy, help you feel relaxed. Take a moment, turn off the news. A colleague I follow calls it the financial pornography network. All it's going to do is raise your blood pressure. Try to tune it out. Don't check your accounts every day. It's never fun to see a big loss, especially if you've been very diligent over the last decade and you now have lots of zeros after your account. You look in and a 10% loss may be a dollar amount that you're like, oh my God, what's happened here? You just want to remember that this is actually giving you a better point to build on going forward. So while it's never fun to go through, we will be better when we come out the other side. David Kelly, who's a strategist for JP Morgan, published a commentary that said, when we look back on the values today, we will not be disappointed at buying in at these prices. And I think there's a lot of truth to that. So while it's not fun in the moment, we just have to, as my grandmother used to say, grin and bear it, get through it, and ignore it. Let's go float in a pool somewhere and try to stay cool. Thanks so much for tuning in. I'm Stacey Hyde, and this has been another episode of Better Financial Health in 15 minutes or less.